Today we got some really good news for markets, but why are stocks selling off at the time of recording this video? In fact, 10-year treasury yields are down almost 11 basis points today, which on any normal day would have caused the Russell 2000, for an example, to rally probably 1 to 2%. Quite the opposite is happening today, and at the time of recording this video, the Russell 2000 is down almost 1%. And there's a couple different reasons for that, and we'll get into it in this video. But first and foremost, we had our first big round of economic data for this week. And first off was ISM manufacturing PMIs that came out this morning. The headline number came in at 48.7, the estimate was 50, so it came in lower than expected. That's great news. ISM manufacturing employment came in at 51.1. The estimate was 49. So a little bit better than expected for manufacturing employment. Not a big deal. Construction spending month over month came in lower than expected at negative 0.1%. The estimate was positive 0.1%. So that's good news. Also seen as good news today. Now, the most important data point specifically with ISM manufacturing or any ISM data is your prices paid component. ISM manufacturing prices paid came in at 57.0. The estimate was 61.3, and that is the reason essentially why 10-year treasury yields are down so much today and rate cut odds are actually rising. Fed fund future markets are now pricing in the first cut by the Fed September 18th instead of what was previously November 7th. Now, odds for a cut in July are not moving as much. That's going to really be predicated around larger economic data points like your non-farm payrolls report coming out on Friday, as well as your next two CPI reports until July 31st. But if you're a viewer of this channel, you know I'm firmly expecting the first cut coming July 31st. And that first cut coming July 31st, in my opinion, will start to have a big positive impact on stocks. Likely mid-June, if not late June, we should start pricing in that cut. So why are stocks down so much today? Well, I think a lot of people, number one, are getting concerned over the New York Stock Exchange's inability to really have a functional market. 3 times now in the past 2 weeks, really 1.5 weeks or so, ever since the New York Stock Exchange went to a T+1 settlement time, you have seen stocks or ETFs get halted, unable to trade for hours in the morning. And today it was really bad. Berkshire Hathaway, that's normally a $600,000+ stock, was halted today for hours, down 99.97%, down to $185 per share. I think investors are kind of worried about this because it's happened so many times in just the last couple of trading days. And it's almost like market makers, they're just not showing up to do their jobs, so these stocks can't open. The other thing that happened today was semiconductors. Now, it's strange, I know. Dell is down 5.5%, AMD is down 3%, SMCI is down 4%, Broadcom's down 1%, but Nvidia is up 4%. Now, you might say, well, why is that negative for broader markets? Well, Nvidia is just pooling the capital. It's like the tide is going out, but Nvidia is still managing to hold all of the water, okay? The tide is going out from other stocks, other areas of the market, small cap, doesn't matter, just other areas, every area, a matter of fact, and it's going into Nvidia. Nvidia's $40 rally today is over $100 billion of a gain to market cap value. That's a lot of dollars, okay? And that money is coming out of other areas of the markets. You're not seeing massive inflows to stocks, right? So where is that capital coming from? It's coming from small caps. It's coming from mid caps. It's coming from just Joe Schmo stocks that, you know, hedge funds, institutions don't want to own over Nvidia. So when Nvidia is having these 4 or 5% days off nothing, it's having a pretty negative impact on the broader markets. And I do think that is part of why markets are down today. Now, you also have big data coming out towards the end of this week, again with the non-farm payrolls report. You do have ISM services PMIs coming out as well here this week. And I think some investors may be looking to hedge out their portfolios. Some investors might say, hey, we've had a good run in stocks. Maybe we want to take some profits here. That's always a possibility. And I really think these three factors are kind of coming together to be negative for markets today. But the fact of the matter is, today was positive for stocks. Today, 10-year treasury yields dropped 11 basis points. Whether stocks go up today or tomorrow based on this, I do believe there will be a rally, especially for small cap stocks, based on the data that we had today. Because the facts are the facts. Today was good news, and kind of like what we seen on Friday with PCE. PCE came out, it was better than expected. What happened? Stocks sold off. What happened towards the end of the day? Stocks rallied. And it wouldn't be surprising if, the last hour or so of trading here, you could see quite a rally towards the end of the day. Like, I would not be shocked if that happened. Now, coming out tomorrow, you will get JOLTS job openings. That comes out at 10 o'clock in the morning. You're expecting 8.4 million job openings. That's slightly lower than what you had last month, but not by much. Last month's number was 8.488 million. Lots of eights there. So you're not expecting much of a change there. If we do see a big drop, markets might not like that because that's a sign the economy is a lot weaker than we think, or the labor market at least. If we do get a drop, let's say 200, 300,000 job ads, then that would probably be seen as a positive for stocks. Tomorrow, you're also going to get factory orders month over month. You're expecting a number of 0.7%. Last month, you came in at positive 1.7%. So there as well, lower is likely going to be seen as better. Big data, though, will be on Wednesday with ISM services PMI. Same is true there. You want to watch that prices paid component. If prices paid falls more than expected, that's going to be what can really drive markets higher on Wednesday. Now, Tom Lee believes we could see a 50% rally throughout 2024 and probably the first parts of 2025 as well. And, ever since Tom Lee said that, the data has been working in his favor, but the markets have not been as much. Again, PCE coming in lower than expected on Friday. Stocks sold off, rally towards the end of the day. IWM today, small caps giving all of that back, plus a little bit. Even though we had really good data that came out for lower inflation and really, the Fed should be cutting rates soon. So the overall logic of what Tom Lee has been saying and what I have been saying specifically here on this channel is correct. It's been 100% spot on. Lower inflation, slightly weaker economy, not an economy heading into a recession, at least from what we can tell the data as of lately, but just slower and overall good for getting Fed rate cuts and should be a good market overall for small caps. It's just not happening yet. Now, does that make that invalid? No, it does not. Markets can be irrational. They can be very, fluid and not logically thinking on a day-by-day basis. But when you start to add these things together, it's only inevitable that you will see a huge rally for small caps and really interest rate sensitive stocks. Now, I don't want to only categorize those two sectors, but those are the sectors that have had the least participation in the market's all-time highs that you've seen in 2023 and 2024. Ryan Dietrich over on X shared a very interesting post. He says this is the best May for the S&P 500 in 15 years. Looking at the 10 best monthly returns ever in May showed the future returns were also quite impressive. Rest of the year up on average, double digits between 10.5 and 4.9%, and June up 1% on average versus negative. So basically what this means is the rest of the year tends to have an average return of 10.5% and a median return of 12.9%, and you tend to be higher 70% of the time. So whenever you have this 4% gain in May, you tend to be positive the rest of the year, over 10%. about 70% of the time. Those are pretty good odds. Now, after having a negative 4% gain or positive 4% gain, excuse me, in May, you tend to be positive on average about 1% for the month of June, so the following month, and you're positive about 80% of the time. So those are very strong numbers as well. Nick Timmerhouse also shares an interesting post here on X, and this could be another reason why stocks are selling off today. It says the New York Fed's measure of inflation persistence, the multivariate core trend rate, saw a big upward revision in Q1. This series has been prone to some large revisions. January is now 3.3% versus 3% previously. February 3.1% versus 2.7% previously. And March at 2.9% versus 2.6%. April was 2.8%. So yeah, still decelerating, but higher levels than we thought, at least previously. I still don't think this is the reason why markets are selling off today, but it could be a reason that's, adding to it. Yardini Research today said even closer to the Fed's target are both the core PCE and CPI inflation rates, excluding rent at 2.2% and 2.1% year over year. We continue to expect that inflation will moderate to 2.0% year over year over the rest of this year without a recession. And here you can see this post from Carl Quintanilla. Here, he's the CNBC host on CNBC. You've seen this guy before. Well, he shared this from Bloomberg. It says a standout dovish hedge seen over Monday's session has been a large buyer of September call flies, targeting a Fed rate cut to be priced by the September policy meeting. Fed swaps are currently pricing in around 15 basis points of cuts, or around 60% odds of a 25 basis point move for the September 18th decision. On a technical basis today, you are above that 50-day moving average for IWM, which is your small cap ETF. You are under your 20-day moving average. Not great. You want to get back above that, but still, as long as you're above that 50-day moving average, in which it looks like you found a lot of support there today, then the upwards trend is still intact. And you could see this was kind of a bad day for everything. 3.5% of all stocks today are falling under their 50-day moving average, which is a pretty dang bad day. But I do think for savvy investors, this does provide a potential opportunity to get into some bullish trades, considering we know the facts are the facts. The data came in good today. The markets didn't react to it as, good news today, like we probably should have. Eventually, they will. So let me know what you think about this information down below in the comments section. What in the world do you think is going on today? I think we're definitely open to opinions on this one. Again, hit the like button as well as subscribe to the channel. You guys have a great rest of your day, and I will see you in the next one.